I want it to be simple.
Yeah.
I want it to be straightforward. I want to understand what it is. I don't want a statement that's 47 pages thick. Like, I will die on the hill. Index funds, simple, keep saving, control your emotions.
Yeah.
I don't think you're ever going to have regrets.
And one more, like, go outside.
Yes, go outside.
Welcome to the Physician Sense Podcast, a podcast designed specifically for physicians, offering a breakdown of complex financial topics to help you develop your financial IQ, further your financial journey, and improve your well-being. Whether you're a medical student, resident, fellow, or attending physician, you're sure to learn something new that will benefit your journey. And now, your hosts, Chad Chubb and Tyler Olson.
We're back for mailbag questions and answers part 2.
Part 2 of this one? I think, have you ever done a mail? We've done individual questions.
Yeah, individual ones. We did that one, Dr.
W, right?
Dr. W. Yes, I think it was Dr. W. Anyway, yeah, we did an entire episode that was just about that. So that was last summer, I think. Anyway, this is fun because like we get a good variety of your questions, and we're super excited to be able to continue this. We are here in San Antonio. Just gave our tax planning session earlier this morning, and we're like, let's just keep rolling with it. Let's talk about money questions. You got a thought?
No, it was Dr. W.
It is Dr. W.
Yep. I just had to double check.
See, nailed it.
Also, Dr. W just sent us a nice email too as a follow-up to all that. So thank you, Dr. W. So when we know where the questions are coming from, we don't miss them.
Right.
It gives good. And we also had another question on the form. Remember we did the, it was the family and like how to gift money.
Oh yeah.
Properly. So we had that one. We did back to back.
That's right.
But these are mail bags. So we're doing like
multiple.
Four, I guess, on these.
So we got 4 more questions for you all.
Good ones.
Yeah. So we're, let me jump into it.
Get into it. I got to get back to my right screen here because I'm clicking around. I mean, you have to be impressed. If you all could see our setup here for doing a podcast and YouTube channel on the road, it's impressive. We're doing good here.
Yeah.
Okay. Jeremy, this is from late 24. Hello. My girlfriend is graduating medical school in June with over $350,000 in public loans. Heyo, that's me adding heyo. I am a high-earning attorney making $225,000 per year. I'm considering proposing to her soon, but I want to better understand how our joint income as a married couple could impact/compromise her potential income repayment plans and/or PSLF. Thank you. Awesome question from Jeremy.
Yeah.
Congrats on the proposal.
Yeah.
Fun step.
In the offing.
Yep.
Yeah. So Jeremy, this is great question. Good you're thinking ahead. Your income is definitely going to have an impact on your girlfriend's student loan planning strategies. So our ability to answer this is hampered to some degree because there are a lot of changes that are coming. We're at the end of February 2025 right now, and there's a lot that we don't know about the income-driven repayment plans, the viability of PSLF. I still think that it's fine for current borrowers, but we just don't know a lot of stuff. But assuming that generally the income-driven repayment plans exist as they are right now, and PSLF is a thing, the major decision that you would have to decide is whether to file your taxes jointly or separately, and the pros and cons of that, because your tax liability is going to be different depending on whether you file jointly or separately, and that will also depend on your state of residence. So, and I presume that you are moving to wherever your girlfriend is moving, and unless she's in urology, she doesn't yet know where she matched, right?
Mm-hmm.
And so you don't know what state you're going to be living in, and if it's a community property state, filing separately has a different impact than in a non-community property state. So, and actually filing separately in this situation would make it it would be less advantageous to file separately, because when you file separately in a community property state, your girlfriend or your wife at that point would be getting half of your income and half of her income combined together on her tax return, and you would also be getting half of your income and half of her income. And since her income is presumably going to be $60,000 to $70,000, you being at $225,000, that is going to augment her tax return income more than it would in a non-community property state by filing separately. But still, if you were in a community property state, filing jointly would create a much higher level of income for her, even more so. So filing separately still might be viable in that situation, but it's going to take an analysis around this decision. That's the main one, right?
Yeah, you nailed it. It's funny. I literally had this question in my little corner after our presentation. And I'm actually amazed by how many, this is very, I don't want to say very simple, but when you run your taxes every year, there's a worksheet it's literally, I think it's called the married filing jointly versus married filing separately worksheet or comparison. And it'll show you, hey, by you doing married filing separately, here is your new tax bill. It's going to be a number listed right out. And all you're doing then is saying, all right, well, if we do that, do we save more than that by doing student loan planning with this IDR plan? Now, to your point, who knows what IDRs look like by the time this podcast goes live, actually, who knows? Might have to burn this whole episode. We don't know.
Right.
But that's really the main part here. I have a fun follow-up question for you based on this. Jeremy comes to you and he says, we're just going to get engaged. We're not going to get married because of student loans.
Mm-hmm.
What do you say? Like they're going to truly delay their marriage just for student loan planning? Because we get this every now and then.
Yeah. I had a conversation
too.
This just happened a few weeks ago. I met with a resident and his girlfriend and him were like, they're like, yeah, we're just going to wait to get married until I get PSLF.
How far away were they? They just starting?
6 years.
Oh,
6 years.
That's a commitment.
Yeah. So you're asking me, what do I say?
Yeah.
Well, I don't tell them what to do.
You don't give marriage advice? What?
That's step number one. Don't tell them what to do about that decision. What I do is I always say, okay, I can understand why you would be thinking about this. And like, here's another thing too. When people tell me this, it doesn't necessarily mean that it is the only reason that they are thinking about it.
Fair. Yeah.
So nevertheless, I approach it as if it is the only reason that they're asking. And I go back and I say, okay, well, let's look at the numbers that you're trying to manage. And so we go through the numbers and we basically identify what the savings would be from a PSLF achievement standpoint by not getting married and not having to deal with filing their taxes separately and all that. And I mean, sometimes it could make a difference, but like just because the other person's income is going, like because the cost of getting married is essentially that the other person, the non-borrower's income is higher. But what that ends up doing is it makes it less of an issue for them to not get as much in PSLF, because if a trainee is getting married to someone with a high income, like saving I guess in the example I'm thinking of, this couple that I was speaking with, they were looking at like a net savings of like $50,000 in extra loan forgiveness.
Okay.
And mind you, that's no small sum of money.
Yeah.
But I said, so this is what you would save if you decide to wait 6 years to get married. And then I just leave it with them to decide, do we want to, like, did we want to get married? We're not getting married. We're going to wait 6 years. And in order to capture this $50,000 benefit.
Yeah.
And like, in those conversations, I'm not going to prevail upon their value or moral system whatsoever in terms of like what they want to prioritize. Like, I don't know, like it's up to you, but I just lay out the numbers. And it was funny because in that particular conversation, they were just kind of like, oh, that's it? And they're like, oh, forget about it.
Good. Yeah. I mean,
like they were just like, they were like, because they thought it was going to be like a massive difference in their financial independence trajectory. And the truth is that like PSLF is really, really helpful. But if we're talking about if we're just talking about managing cash flow, and if you don't get PSLF or you get less PSLF, it just means that your net savings rate for like a couple of years is a little bit tighter. And that's pretty much the only difference. And in the grand scheme of things, it's a blip. So like in the relative to like major life decisions and values, if like getting married is one of those things, I'm like, I tend to diminish the value of maximizing PSLF. But everyone's got to make their own choice. They got to know. We all know ourselves what we care about most.
Yeah, I mean, outside of the numbers, I always think to myself, isn't it sad where student loans have gone? The fact that you have to have a conversation, on delaying marriage. So that's a whole nother moral conversation, but that's just where student loans are today. My theory has always been, if you have to delay it like a year, maybe 2 years, I think that's achievable if there's a decent savings rate. I'm talking from the moral side, not the number side. But you get into like 6, in Jeremy's example, talking probably like at least 6 years, right? Or she's
just graduating medical school.
Oh yeah, so 10
years.
10 years, yeah.
10 years, right.
So I was thinking finishing training there. 10 years.
Yeah.
Like that's insane that we even have to have this conversation. Like that's wild.
Yeah. So, and Jeremy, to your point of your question, we hope that you're having a better understanding of like what the decision process is. Cause like, yeah, it is something that you have to navigate. If you get married sometime this calendar year of 2025, you're going to have to file a tax return either jointly or filing married filing separately for 2025. But you got plenty of time to be able to let the IDR plans and PSLF news and all that stuff sift out if you end up getting married. Although if you haven't proposed, I know a lot of people, they don't get married that fast. But whatever year you get married, the impact is going to be felt that following spring. So it's good you're thinking ahead. The main thing you'll have to consider is tax filing status, right?
Yeah. And again, there's going to be the number crunching side to it. There's going to be the value, moral, human side of it.
Yeah. And another thing too is that it's good you're thinking about this in that your income differential is huge. And so there's a lot of times there's some people have feelings of like guilt. Some people have feelings of kind of feeling being taken advantage of a little bit, even though they don't feel like that way exactly. The higher earner might feel that way. The lower earner might feel guilty. I know couples that I've worked with who went through training and they come out and now the attending physician is like, I'm going to pay for stuff. And they're like, I can pull my weight now. So there's a lot of those dynamics. So as you contemplate this, if you do decide to get married and move forward, like where you're actually talking about money stuff together, make sure you're talking about all of it and all these things, because it's going to start to blend into like cash flow management too. And just having an understanding of who's responsible for what and who can reasonably be responsible for what expenses.
Yeah. Solid question, Jeremy. Actually, it's kind of nice to see student loan questions again.
Yeah.
I've actually got another one. So Matt, January of this year, 2025, navigating the current SAVE plan is challenging. Amen. I think particularly for dual physician households, both with student loans aiming for PSLF, I'm interested in your opinion for those in limbo regarding what we should be doing now. Switch out of SAVE? If so, to which plan? Stay in forbearance?
Man, this is a great question. And I think maybe, you know what we should do? We should record this question again. Because like the answer right now, Matt, is nothing. Like if you're both on SAVE, and so you're in the SAVE forbearance right now, end of February, like you can't even, because like we're in the middle of the week following them closing down the IDR application
paper
system.
Applications right now.
Like yeah, so like it's like there's everything has come to a halt. So let's do this, Matt. We will put your question on hold because the only thing we can tell you is to wait. And by the time you actually hear this, a lot of things will have changed with the SAVE plan. So unfortunately, there's just not much else to say, right?
Yeah. And whether you are Matt on this one or anyone with so many student loan questions, when we get clarity on this, I assume that this will be, we haven't done a lot of emergency episodes where we had to record and put something out right away. I feel like student loans, whenever this dust settles, we probably have some like emergency podcast.
Yeah. Yep.
To like get them out there.
Yeah.
Because right now we're in February recording out to June. So there's probably going to be a day where we jump in here, record, and get something sooner. So Matt, we will keep this question in mind. I mean, really, your question is probably the question like most people, the bulk of people in student loans right now. So Matt, even though you had to wait 6 months for us to still say we're punting.
Well, wait, no, Matt. 2025.
Yeah, but by the time this goes live, June.
Oh, that's true.
Yep.
Yeah. Okay.
5 months. 5 months.
Right.
Regardless, Matt, thank you for your patience. But you didn't miss anything.
Right.
That's the key. You didn't miss anything. Even if we would have got to this sooner, which we wouldn't have, it's only been a month, but there still wasn't an answer. So
true.
Matt, thank you for the question. Keep sending great questions. We got much better student loan details coming for you. All right. This is from Sam. I promise I did not make this one up. This is also from January. Never been a podcast listener before, but you guys are changing that. Thank you, Sam.
Oh, that's so sweet.
Thank you for this. And that was from Sam. Any tips for taxes the first year of changing from fellow to attending? Thank you. I actually read this question wrong the first time. So any tips for taxes the first year of changing from fellow to attendee?
Tips for taxes. That sounds like a good business name. Tips for taxes.
That could have been the name of our presentation today.
Oh, yeah.
Yeah. Because everyone thought the name of our podcast or company was
It's tax savvy.
Tax Savvy.
Right. Yeah. Physician Sense, right? Yeah.
Yes. Yes. Sense, CENTS as well. Yeah. What thoughts come to your mind here first?
So with the exception of the very DIYer, only W-2 income attending physicians, if you're really into DIY tax filing, it's time to hire a tax pro.
That's a good point there.
You don't have to hire someone to do extravagant long-term tax planning and accounting if you don't want to. You can hire a tax filing accountant that can help you with the process of gathering your forms and making sure that you're making the right decisions in terms of tax filing. And that's like, if you happen to be, Sam, if you happen to be someone that's also managing student loans, the decision of filing separately versus jointly, if you are also married, is going to be something that you could lean on a tax accountant for. I would say, because like in our planning practice, we do a lot of tax planning. So if you are going to hire a financial planner, make sure that you're going to get them to address tax questions. Because if you're going to go to the expense of doing it, you want to make sure in your interviews that you're asking to make sure that you're going to get that sort of stuff covered. Because that's like, in terms of like planning assistance, tax, employer benefits, debt payoff strategy, all that is like far more time sensitive. Oh, disability insurance, all that is far more time sensitive than investing, which is like what most, advisors or planners will lead with. So make sure that you're filtering for that. What do you think about new attendings? They get their first job, they're starting in September, and they're like, I'm going to max out my 403B. Do you like that? You like that idea?
It's funny. I was actually thinking this as my first thought. I'm okay with that. Here's what I'm not okay with. We have seen this error before. Remember, employer A in training is not talking to employer B.
Oh, right. Yeah.
So one huge error we see here quite a bit is they already put money into the 403B while they were in training, and then they go, hey, I want to max out this. So that system wasn't talking to each other. So let's just say you put $10,000 in your 403B in training. That's probably a big ask actually in training. Let's just say $5,000. And then they start your new role, right? And then you say, I want to max it out. So another $23,500 goes in. A and B aren't talking to each other. So you're actually $5,000 over the contribution limit. And that actually can get pretty nasty if you don't fix it. So that's the first thought that comes to mind. But to answer your question, I'm okay with that.
Yeah.
I'm okay with backloading that last year.
Mm-hmm.
We've even had some physicians where if they signed their contract and we see they're going to have a better match on the attending role, we actually won't have them do anything their last year of training to get the better match to end the year.
Right.
So there's a little bit of gamesmanship in there.
Yeah. Yeah, that's a good move.
The other thing I was noting here, your question nailed what my head was thinking in advance. This is like the common error year for backdoor Roths. So if you thought at the start of the year, you're like, my income's low enough to go directly to a Roth, but now you're an attending, you also got a bonus and you go through the thresholds. This could be a year that ideally you either did the backdoor Roth to start, or you might have to fix some things if you did that. If not, don't worry about it. But those are the first two things that came to mind besides what you said. Hire an accountant for sure.
Yeah. If you're going to be, because by the time you hear this, it'll be the middle of 2025. So what you got to do is, if you found yourself in a situation where you did make direct Roth IRA contributions, and you've you've extrapolated the numbers and that your income, if you're single, I think it's like, what is it, like 160,000. The income limit for Roth contributions for a single person, I think, is around 160,000. And then for a married couple filing jointly, it's going to be north of $230,000. If you're going to be north of those numbers in either respect for this tax year, that'll be the addition of your fellowship salary January through June, and then your attending pay whenever that starts. If it's August or September, October, all the way to the end of the year. Bring that together, add the bonuses. If you realize that you are going to go over that threshold, then obviously definitely stop Roth contributions now. And then you want to do a recharacterization of the Roth contributions for this year as soon as possible. Because what happens is you put the money into the Roth, you weren't supposed to, it's invested and it's growing theoretically. You can withdraw that original contribution, but you also have to withdraw the earnings or profits associated with that contribution. And the longer you leave it in there, if the market continues to go up, it's that much more profit that's going to be taxed, essentially. So like say you made, you put in like $3,000 up to the end of June, and it's like that portion, is like $500 associated with it in terms of profit. You're gonna have to take out all $3,500, and you'll and if like you use like a platform like Fidelity, they have a really easy way to recharacterize. You move the $3,500 back from the Roth into a traditional IRA. You're recharacterizing it into traditional IRA contributions. And then if you want to then complete or close the loop on this, you move the $3,500 back into the Roth. Except that $500, that's going to be taxable. If you wait until the fall and that $500 grew to like $600 or $700, then you have to pay taxes on $700. So it's good to prioritize getting this recharacterization done. So that's another thing to think about as far as taxes are concerned. Yeah. I mean, there's a lot of ways to go to. Like, oh, yes, here's something else.
Got a good one.
So these forgivable loans, you got to find out how you're getting paid. If you got like a residency stipend, or if you got a starting bonus, or if you have a guaranteed salary that has been structured as a forgivable loan, then you need to account for tax payments that are going to be coming in the future on income that you're earning now. You will not pay taxes on it this year. You'll pay taxes on it probably in 3 years. And it'll hit you like a ton of bricks if you're not prepared for it.
Yeah.
So that's a major issue that I run into with a lot of people that are like in these incentivization programs where the hospital system wants to get you locked in and they're willing to pay you either like a stipend in training, and they structure it as a forgivable loan. And by the way, I keep saying that because sometimes they just pay it to you and they withhold the taxes, like I think is better. And then this isn't a forgivable loan. So the best way to know for sure is whether the money that you're getting is like a straight dollar amount, right?
Yeah.
If it's like, weird numbers, like with something and 28 cents, then obviously like taxes are being withheld. But you want to confirm, how am I getting paid? Is this W-2 income? Is this 1099? Because that's another one, right? With 1099, that's going to be due like that year.
Yeah.
So right? Yeah. So like if you got a bonus in August, like a sign-on bonus, and they structured it as a 1099 bonus, then you really should be paying the taxes on that on September 15th.
Yeah.
Ideally.
Yep.
So
whatever that quarter it falls in, you're trying to true up at that point.
Yeah.
On your weighted numbers when they do that overpayment.
Right.
I guess I should say underpayment in that example.
Yeah. So this is getting into the weeds a little bit, but basically what Chad is referring to is that money that you receive as income that did not have taxes withheld, like a normal W-2 paycheck, that was received between January and March, January, February, March, you have to pay taxes on that money April 15th. Money earned April and May has to get paid on June 15th. Money earned June, July, and August has to get paid on September 15th. And then September, October, November, December gets paid on January 15th. You go to irs.gov/pay, and you can pay online to pay directly from your bank account. And then if your state charges income tax, present company excluded, Mr. Florida, then you also have to go to their site, their revenue or treasury department site, and make a payment. And so it's really important to know any sort of bonuses that you're getting paid. If they're 1099, you got to get those taxes paid. So it's not all yours, unfortunately. You have to pay the taxes.
With your fun note about Florida, I've been chuckling. So inside story for everybody, we file our own taxes for Physician Sense. And Tyler and I, as financial advisors, didn't run our own numbers. And we started our group in Connecticut. Connecticut has taxes. Should have been in Florida. Help me out. But the funnier part of all this is Connecticut's tax system is essentially like not working at all right now. And every time I get an email from the accountant that we utilize, I keep thinking to myself, it wouldn't be happening in Florida. Wouldn't be happening in Florida.
Bringing you down.
I think we just got overly excited that we're like, did we just build something together? We did. Yes.
Yeah. And now we're like, oh no, now we have to maintain it.
We're good. We'll get it fixed up.
Yeah.
All right. This was nerdy. Actually, if anyone thought I was kind of over to the screen while Tyler was talking, I had a whole chart saved for this question. I nerded out on this question because I feel like I never get good investment questions. So here's the question, and then we'll add some context to it. I would love to know your thoughts on investing in small cap value funds, especially the ones that are offered by DFA or Avantis, given that they are more expensive yet are supposed to be better than other purely passive index funds. I thought Jack Bogle said you get what you don't pay for, but I guess you get more nuance into small cap value indexing. This is not really true, ? This is also from this month. We're calling up February. I'm just going to say Raceleri, Racelawi, sent us this question.
I'm guessing I'm going to go with someone named R, middle initial A. Well, maybe I shouldn't say all that, right? Because I want to keep it anonymous.
Well, they're probably going to piece it together regardless. Either way, that was the hidden name that was provided to us. We won't provide any more details. Right. I'm going to start this one because I dug into it a little bit, but then I want to get your context. In full disclosure, well, actually here, it says it in my note. So here were the notes that I actually typed out. I keep thinking this is the camera, but that's the microphone. The camera's here. Right. Okay. So we, as in WealthKeel, we very rarely will look for small cap value. Like, for example, let's just say that we have a 401k investment platform that, Physician A sent to us. We're usually looking for index fund or a blend. A blend, not familiar with blend, usually has some growth and value. This question is specifically for small cap value. So this is kind of nerding out. But I was like, you know what? Let's have at it. So what I did was I actually went into Morningstar and I pulled in all the past data. So for example, the DFA small cap value fund, when you include the expense ratio, that's the important part, right? When you're trying to say, hey, is this more actively, and I actually like both of these fund families. I think they do a great job. When you're trying to compare this more expensive model investment option compared to the passive fund, you got to include the expense ratio in the performance. So when I put out this chart going back to 2021, I think it was. It went back a few years. Let me just read through this. So for 4 of the years, it was a wash when you included the expense ratio, meaning that it was pretty much break even. When you included the extra fees of the small cap value fund compared to the small cap index, you didn't get anything good out of it. Now, 3 of the years, there were a win, meaning that the more active fund, even with the expense ratio, did outperform. And then it was 4 years where it lost. So it was clearly, what is that? That's 11 years there. That included the current year. There's my note. Includes year to date. 2021 and 2022, just in case if someone's going to try to call out numbers here, I know I'm just saying they were wins. Those are pretty substantial win years. Now, the Avantis small cap value has not been around as long. So this one only went back to 2020. With the expense ratios, 4 wins, 1 wash, and 1 loss. The loss is actually this current year, 2025. So we're kind of early in the year. So in this example, sure. Could an active fund win? It could, but not all the time. Like let's just stick with the DFA fund. Not all the time.
Right.
Avantis has had a hot streak there. Actually, when Avantis started that fund, I think small cap value in general had like a tear for like 3 or 4 years.
Yeah.
But then we get into like, is this overly complicated? And then I put a separate note on, while the numbers were impressive, what was the rest of your diversification, right? Because large cap value has also done really well in this period of time.
Right.
Were you overweight international? International has done really well, or really bad compared to U.S. stocks over this period of time. So we're comparing one asset class compared to everything else, where I think the whole portfolio matters. And I still come back to, I don't think you ever have to be this nuanced in looking for allocations. I do think certain asset classes do maybe do a little bit better with a little bit more active management. DFA is a really good fund family. Avantis, I mean, people that use DFA funds usually drink the DFA Kool-Aid. Like, they love DFA funds. Yeah. Avantis is based on my friends that I hang out with conferences, I believe these two actually are pretty big juggernauts. I don't think they like each other. But what are your thoughts? I just felt like doing investment research because I never get to do it.
Yeah. I mean, I think that this is a good lesson in finding out at the end of a long road that doesn't really matter that much. In terms of asset allocation, it is so much more important to improve your savings rate or to make the most of it and invest as much as you reasonably can. The what you invest in, that part of it is so much more diminished in terms of importance. Like, I remember, is it Meb Faber?
Yeah, Meb does a lot of
this was like almost a year ago. He wrote out a report and shared it. And basically it just came down to that in terms of like active asset allocation over many, many years, it really has not mattered.
Well, I'm just thinking in my head too, the number that I should have did here was not comparing it to the small cap value index. I should have just did small cap in general.
Sure.
Because then you're like, if you're getting very little difference, or if small cap blend has outperformed over that 11-year or a little bit shorter period with Avantis there.
Yeah.
Then it comes back to simplicity. And even there, it was still, again, using DFA, 4 with a wash, 3 with a win, 4 with a loss.
Yeah.
It's not like you got really far ahead doing this.
I guess what I would say to anyone who's asking about this, like, is it worth it? Right? Is it worth your time? Is it worth taking on the risk? And in my mind, it's the best option is to keep it simple, to keep it in a way where you're focusing your mind and your time on the things that you actually like. Now, you sound like you might be a person that really likes to nerd out on investment strategy. And if you enjoy this and you're okay with the possibility that going with an actively managed small cap value fund may win sometimes, may lose sometimes relative to the index, and you're wanting to kind of play that game and kind of just see how, test it out, by all means, you're not going to hurt yourself, but by using reputable management companies like DFA or Avantis, that's fine. But if you're doing this strictly because you're trying to see if it's more financially advantageous, I would say don't mess with it. Like, I am such a simple investment or simple index fund guy. Like, I would rather use my brain for something else. And like, even in like the financial and investment planning area of things, like with our work, like, we don't spend a ton of time on the asset allocation because there isn't very much achievable and tangible net benefits from really digging into the weeds here with asset allocation. There's so much more to be reaped from finding out ways to improve your savings rate, to improve your income, to improve your tax liability, those sort of things. So that's where my mind tends to go. It's interesting if you find it interesting. That's I think what I think.
Yeah, I don't know how your questions went after the presentation from today. I was actually amazed by how many physicians that were closer to the decumulation phase came up to me and said, I want my portfolio to be more simple. I actually think your direct indexing comment freaked people out on holy cow, are we overly complicated?
Yeah. Well, I hope I freaked them out.
You did.
Like,
That's what I mean. Like that was like 4 of my questions.
Really?
Yeah. That were all about the one physician that came up to speak with us, she was like, I had directing this and it's terrifying. But the whole point of that being how many of them closer to the decumulation planning phase now were like, I want it to be simple.
Yeah.
I want it to be straightforward. I want to understand what it is. I don't want a statement that's 47 pages thick. Like,
Yeah.
And not that, I mean, this question, they might just be trying to add a little bit of satellite risk and the rest of their portfolio is 5 index funds, but they wanted to add some small cap value. We could be reading into this too much.
Sure.
But I think if it is that simple, good, great. But I think the bigger question again is, I put my note there, I will die on the hill. Index funds, simple, keep saving, control your emotions.
Yeah. I
don't think you're ever going to have regrets.
Mm-hmm. And one more, like go outside.
Yes. Go outside.
Yeah.
Spend time with your significant other, your kids.
Yeah.
Find a hobby or two.
Yeah.
I'm not a big bird watcher, but we're in the hotel room now and you can't see this, but I saw a red-tailed hawk fly by twice. And I thought to myself, that'd be a nice hobby, bird watching.
Yeah.
I haven't seen him again, but
get some binoculars.
Yeah. We were going to originally try to record this outside. You can blame the power washers. Loud as heck out there.
Yeah.
But all right.
Anyway, thank you.
Mailbag episode.
Thank you all for your question.
Yeah.
That was like really, really great questions. So keep them coming. We will be more quick about making sure that these are responded to with, even like now, just because of the pace of our episodes and stuff, they're coming out later.
Yeah.
But you won't have to wait a year.
Yeah. Well, and if you do them on the website, if you go to physiciansense.com and scroll down, you can send us a question there. Those are emailed to us. And actually, if you're on my side, if they're actually emailed to me twice because I get them from you and then Tyler forwards them again to me because he doesn't think I get the first one. But I do. So we get those quickly. It's the Google form one that we messed up on. We forgot to jump in to check that. So even no matter how you do it, we'll find it, whatever's comfortable for you. But again, I think mailbag episodes are so cool. So,
yeah, it was fun.
And fun doing this in person.
Yeah, good to see you, man. We'll see y'all later.
This information is for general purposes only. This information is not intended to be a substitute for specific professional, financial, or tax advice, as individual concerns vary. Please see a financial professional, CPA, and/or an attorney in regards to your own individual situation. Wealth Heals Advisory Services and Financial Planning offered through Vicus Capital Inc., a federally registered investment advisor. Olson Consulting LLC, offering advisory services and financial planning, is a state registered investment advisor.